Imagine checking the markets and seeing a sea of bleeding red. The headlines scream, U.S. launches strikes on Iran. Instantly, human psychology takes over. The brain wonders, is this a major conflict? Will oil skyrocket? Is a prolonged market downturn next? For many, the natural instinct is flight, to step away from the market to protect capital. But then, just hours later, something fascinating happens. The geopolitical news takes a sudden turn. The U.S. walks back further military action and hints at a draft peace text. And Wall Street? It doesn't just recover, it explodes. The S&P 500 stages a massive sudden relief rally. Sharing this as of June 14, 2026. To anyone watching from the sidelines, it feels completely irrational. It feels like a sick joke. But today, we're going to look under the hood of Wall Street for purely educational purposes. Because this exact U.S.-Iran market whiplash is a textbook case study in how global markets actually process crisis. And understanding these mechanics can completely change how you view market volatility forever. Let's look at the facts. On the surface, it makes absolutely zero sense. Conflict is bad for the world, so shouldn't it always be bad for stocks? To understand why it isn't, we have to look at a core principle of behavioral finance. The market hates uncertainty far more than it hates bad news. Think about what happened when those first strikes hit. Institutional models and trading algorithms didn't know how far this would go. Will the Strait of Hormuz close? Will oil spike past $100 a barrel? Because the future was unknown, the market rapidly priced in the absolute worst-case scenario. It acts as a defensive adjustment. The price drops to absorb the shock of the unknown. But look at what happened next. The second a peace text was mentioned and the situation de-escalated, that unknown suddenly became known. The catastrophic worst-case scenario evaporated in a matter of minutes. And when a massive layer of uncertainty is suddenly removed from the table, the market doesn't just creep back up, it springs forward like a snapped rubber band. That is what economists call a relief rally. It's not an endorsement of the news, it's simply the math of risk being removed. Now, let's break down the mechanical trap that happens during these events. When scary headlines hit, emotional trading spikes. At the same time, short sellers, traders who bet that prices will drop, pile into the market. But this creates a highly volatile ecosystem. The moment the news shifted toward peace, those short sellers got caught in a dangerous position. To prevent massive losses, they were forced to rapidly buy back the shares they shorted. When thousands of algorithms and traders are all forced to buy back shares at the exact same time to close their positions, it creates an artificial wave of buying pressure. This is what Wall Street calls a bear trap. The market data tricked participants into thinking a prolonged crash was coming, only to trap them in a mechanical short squeeze that fueled the violent rally upward. What can we learn from history? Is the U.S.-Iran situation unique? Not at all. History shows us this is a repeating pattern. Let's look back at 1991 and the Gulf War. Leading up to Operation Desert Storm, the stock market tanked for months out of pure anxiety. But the literal day the military campaign began, the stock market didn't drop further. It rallied 4%. Look at 2003 and the invasion of Iraq. The market actually hit its bottom right before the conflict officially started and then entered a major upward trend. Why? Because the market prices in the anxiety and the fear of the event long before the event actually unfolds. Once the event occurs and the path forward becomes clearer, the uncertainty dissolves. If you analyze the last 70 years of major geopolitical crises, from the Cuban Missile Crisis onward, the historical data shows that while the initial shock causes a temporary dip, the market recovery period is often much faster than people expect. So, what is the ultimate educational takeaway from this U.S.-Iran market whiplash? It teaches us the danger of trading the first headline. When massive global events occur, the first 24 to 48 hours of market activity are almost purely driven by emotion, automated algorithms, and forced liquidations. Trying to navigate that window based on panic or hype is mathematically incredibly difficult. The case study of this week reminds us that studying market mechanics, understanding risk premiums, relief rallies, and short squeezes is far more valuable than reacting to breaking news alerts. The most disciplined market observers know that volatility is a test of psychology, not just finance. Hit that subscribe button to stay informed. See you in the next video.